it is coming. It hasn't gone away. And my job is to make that time, time that out as best as possible. Chaos is coming like we've never seen before. Stagflation is coming like we've never seen before. Coming to the United States of America. And are you prepared for that in your 60/40 buy and hold target date fund?
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Michael Pento joins us today. Michael is the president and founder of Pento Portfolio Strategies with more than 30 years of professional investment experience. He's worked on the floor of the New York Stock Exchange during the mid 90s, and he also was the portfolio creator and consultant to Delta Claymore's commodity portfolios, which were distributed through Claymore Guggenheim's sales network. And we're delighted to have Michael join us once again today. It's time to saddle up and silver up for Michael Pento. Michael, welcome back to SBTV. How are you doing?
I'm doing well, Patrick. Always good to be with you.
Glad to have you back on, Michael. Really do appreciate you being here once again with us. Michael, in a recent article on your website, pentoports.com, titled Bond Market Wild Card, it was stated that Wall Street is celebrating the 50 basis point rate cut by the Fed, and Wall Street says the Fed's put is back in full force. What actions would we be looking at the Fed taking with consideration to the Fed put back in full force?
Well, what I said, to be clear, was that Wall Street thinks that the Fed's put is back in full force. But I went on and I went to great pain and details to show on the web in the commentary that every time the Fed cut interest rates, it's not exactly the panacea. Oh boy, the Fed has our back, so let's just buy stocks. That's the reflexive action from Wall Street, as always. But I pointed out that the last three times the Fed cut rates, let's see, 2020 was the pandemic. Fed cut rates quickly back to zero from I believe they were around 1.75% at the time. And the stock market lost 35% in like a few weeks. So that didn't work. And then we had 2007 when the Fed started cutting rates by 50 basis points, coincidentally. And by March of 2009, the S&P 500 was down 50%. And it's the same thing in 2001. The Fed cut rates by 50 basis points, and 2 years later, about 2 years later, the S&P was down 50%. So I don't understand why people think that just because the Fed is cutting rates, that it's a panacea. It's not. It's very common in the past that when the Fed is cutting rates, that things fall. It's because things are falling apart. Now, it's always the zeitgeist on Wall Street that, well, this time the Fed's cutting rates because it's just precautionary. The housing market's fine, and subprime is contained. It's just like like an insurance. This is insurance policy. We're cutting rates by 50 basis points just in case something happens. That's what I heard in 2007 too. So let me give you quickly three things that are very, very different this time. I'm not saying the market's falling apart right now. It isn't. I run money for a living, and my portfolio is doing well, thank God. And I'm not short right now. But here's why I'm concerned. I'm concerned because the bond market. I wrote a book about this in 2013. I said someday the bond market is going to fall apart, and I didn't mean 100 years in the future. I didn't mean in 2014 either. I just said at some point the Fed is going to have a dilemma where they're going to have to. They're constantly providing low interest rates in real terms. You're going to create eventually inflation, and that's going to send the bond market higher. That's what I said was going to happen. That's exactly what's happening. So you have this time you have illiquidity concerns, insolvency concerns, and inflation concerns, which are driving up bond yields, which is completely the opposite of what's supposed to happen and what the Fed wants to happen.
This liquidity in the bond market, should it run dry or sort of evaporate? What do you think it's going to look like then?
Well, I think the liquidity is running dry. So we have two sources of primary liquidity right now. Don't forget the Fed is still doing quantitative tightening. Now, I'm sure they'll end that soon. So, but they are supposedly doing quantitative tightening at the same time that they're supposedly lowering interest rates. So, the short-term rates, the Fed funds market, and then you have the repo market. But anyway, it gets very confusing, and I don't want to get into the weeds right now. I'm just saying the Fed is draining its balance sheet right now. That's what's happening. Okay, but you also have the reverse repo facility, which was once $2.5 trillion. This was all the excess reserves, all that money that was printed by the Fed was given to banks as Fed credit. That was parked back at the Federal Reserve because they were paying interest on these reserves, right? That's gone from $2.5 trillion to $200 billion. So for all, I don't think it's going to go to zero. It's pretty much at zero. It's effectively dry right now. You're not going to see, hundreds and hundreds of billions of dollars coming in every few months from the reverse repo. So it's just not there anymore. Then you have the Treasury General account. That's going to be drained, I think, by Q2 of next year. And that's, money the Treasury parks at the Fed. I think they're going to have to use that money because guess what? I don't think we're going to have anything to agree on in Washington, D.C. in January. I think we have a deadlocked Congress, lots of confusion and moving parts with the election, but the chances are very high that Janet Yellen's going to have to use those funds in the TGA to keep the Treasury afloat, to pay its bills. And then you're going to have a repo crisis. You're going to have spiking interest rates in the money markets, and that's when this whole thing falls apart. Now, listen, I'm not a Cassandra. I'm not the purveyor of bad news. I'm just being realistic. Patrick, we had negative, we have negative real interest rates, but we had interest rates that were unbelievably low, close to zero, under 1% for 10 of the last 14 years. That created massive distortions in the stock market and in asset bubbles and debt that's outstanding. And there will be a price to pay for that. It is coming. It hasn't gone away. And my job is to make that time, to time that out as best as possible. Chaos is coming like we've never seen before. Stagflation is coming like we've never seen before. Coming to the United States of America. And are you prepared for that in your 60-40 buy and hold target date fund?
Yeah, that's a great point. I don't think a lot of us are prepared for that. But 2 points came up as you were speaking. The Fed is taking down that balance sheet. Yes, the reverse repo market is going down. Yes, but at the same time, when we look at the M2 money supply, it's starting to tick up again. So how do we read this where these things are coming down, but at the same time, Fed is starting to crank up that printing press again?
Well, the M2 money supply is a product of banks, so it's a broader monetary aggregate. The Fed only controls the base money supply,
Okay.
which is the Fed's balance sheet, basically the Fed's balance sheet. So there's physical coins and currency in circulation, and then there's Fed credit. That's what the Fed directly controls. So the banks are starting to lend a little bit of that money out, but that's because we just talked about the reverse repo facility. So that credit goes from laying fallow at the Fed, goes to the banking system, and the banks use that credit as a base to make loans. So I mean, it wouldn't shock me that the M2 money supply is growing from its normal pace of growth is like 6 or 7% per annum. Now it's like 2%. Okay, whoop-de-doo. Great. But that's only a byproduct of all that credit coming out of the reverse repo facility and the TGA. That's going to end in 2025. That's just a fact. And then we'll see what happens with the economy. The economy and the asset prices and asset bubbles in particular, commercial real estate are going to have they have a lot of problems ahead of them. Remember, we have a dysfunctional, frozen, warped and disfigured real estate market. There's no transactions anymore. You've got sellers that are living in the past thinking that this is like, the post-COVID wave. And home prices are just too high relative to incomes. They're at an all-time record high relative to incomes. Then when you add in taxes and insurance and maintenance costs to the house, they're astronomical. And guess what? And here's the primary point. Normally, the Fed saves the economy from a from a recession turning into a depression by lowering interest rates across the yield curve. And mortgages are kind of pegged more towards the benchmark 10-year treasury, right? Well, guess what happens? Since the Fed decided that the economy really needs more inflation and we want to get interest rates to fall. That's what the Fed said. The Fed said that they wanted interest rates lower. They lowered the Fed funds rate by 50 basis points. But when they did that, the funny thing happened. The 10-year note went from 3.6% to 4.3%. So mortgages are soaring. Mortgage rates are soaring right now. Not falling, soaring. And so is everything else priced off of long-term interest rates. Okay? So I wouldn't think that this 50 basis points the Feds put and they got your back. I don't think that zeitgeist really works this time at all. It's the opposite. It's the opposite.
If you're enjoying this interview with Michael Pinto and I, please consider subscribing to our YouTube channel. And if you are a subscriber to this channel, please do check to see that you are still subscribed and have not been unsubscribed. I myself have been unsubscribed from this channel without my doing or knowledge. And as always, if you have any questions about wealth protection, storing offshore precious metals, or even generational wealth, please feel free to email me at patrick@silverbullion.com.sg, and be sure to visit our website, www.silverbullion.com.sg. Yeah, with the with the housing, I think a report just came out today where I'll just read it here. Home prices hit a new record high, but the pace of growth is slowing significantly and showing signs of strain. So this is exactly what you're talking about.
Well, the supply of homes on the stock market, on the real estate market is soaring. The supply of homes for sale. Don't forget, there were many years post-COVID that, and that was 5 years ago, that 25, 30, 60% of all homes were purchased by investors in those years. The investors are sitting on a mountain of properties, single-family homes. Wall Street is sitting on a mountain of properties that they are selling now because it's easy. When you think about selling a house, so your primary residence, well, I got to list my house, and I got to find another place to own. I got to change all my addresses, and I got to move. We get a mortgage, and I got to do. When you think about what an investor has to do, they look at it like a stock. I'm up 60% in this stock in the last few years. I'm calling my real estate agent. They sell it, and I don't do anything. There's nothing else to do. I don't have to move. I don't have to get a mortgage. I don't have to tell my wife that we're going to sell the house and rent someplace for a little while. I don't have to do anything like that. I just call my real estate agent and sell it, and that's exactly what's happening. It's happening all over the country, not just in Texas and Florida, where everybody moved to post-COVID.
Just want to touch a bit on inflation. Goldman Sachs analysts are speculating that the 2.4% inflation number could be rounded down to the Federal Reserve's 2% target rate in the revision coming later on this month. Michael, does the Fed hitting its 2% target rate really mean much for the middle class, considering prices for everyday things are still up?
Well, here's a golf clap for the Federal Reserve. Well, congratulations. After 43 months of missing your target to the upside, your asinine 2% target. I mean, think about this. I mean, this is how confused we could talk for hours on the Fed. I'm going to Reader's Digest this as best I can. And forgive me, it probably won't be that great. But so Fed used to be in charge of stable prices. Now, then it morphed to 2% inflation, and now it's 2% plus because the Fed is trying to get inflation to go higher, even though it's been above 2%. It's still far above 2%. It's not 2%. For 43 months, you've been above target. You would think you would be raising interest rates. Hey, I got to get one of these months. I got to get below 2 because I kind of want to be, around 2. So let's wait till I get below 2 for a while, and then I'll think about stopping raising interest rates. They're cutting interest rates, saying that he wants more inflation when inflation is above 2%. And by the way, Patrick, what inflation are they looking at? Is it CPI? Is it core CPI? Is it the super core CPI? Is it the core PCE? I mean, what is, they don't know. The Federal Reserve, this is the point. The Federal Reserve has no clue how to measure inflation. No clue. And they have even less of an idea of what causes inflation, yet they're setting policy. They control, they have so much power now. They control the entire economy. Housing prices, stock prices, cost of funds, the amount of reserves in the system. They control every damn thing based on what? Their omniscient knowledge of the level of R star. Is that what that is? The R star level. The level. I mean, it's so darn disgusting. It's an odious organization full of hubris. But I will just want to say this. I want to comment on this because I'll touch on your point. You made it very succinctly, much better than I did. That's the level of prices, the level of how much it costs for a dozen eggs has already wiped out the middle class. The fact that they're only rising at 2.5% and not 9 is better, but it's still horrible that they're not falling. And I have one more thing to say about this. I heard one of the founders of Bloomberg, I think his name is Winkler, something like that. Yeah, no. He was talking, he was one of the nice reporters there, asked him a question and said, you know what, he's saying that prices have fallen back down to where they were prior to COVID. That is just a lie. It is an absolute, the level of prices. You look at the CRB index, 19 commodity prices. You go yourself, Mr. Winkler, look at the CRB index. Look at the home price index. Look at stock prices and tell me if they're anywhere near where they were in 2020. It's just a lie. And then he says that they've kept that inflation is below incomes. But he's looking at average incomes based on CPI. Their actual level of inflation, number one, is much higher than CPI. CPI is up 22% since COVID. Wages are up 22% since COVID. But real prices are up 40 to 50% since COVID. Look at all those things. Look at your insurance bill. Look at your house. Look at the cost of running your house. But Mr. Winkler, what about all those people who are on a fixed income and don't get wages? They get a small Social Security increase. It's very small, tiny Social Security. So, I mean, he's just playing politics. The level of prices has wiped out the middle class. That's a fact. The fact that they're rising at 2.5% from that level is still disgusting. All right, I tried my best.
No, you gave some good juice there. I
No, by the way,
appreciate that.
that's why I'm not, Patrick, that's why I'm not on TV anymore. Because I would have told Mr. Winkler, all right? I think his name Winkler. He was a co-founder with Mike Bloomberg, editor in chief. You know, I guess you had to let him get away with what he said. If I was on that TV show, I would have just said what I would have said, and he would have been like this because he could not answer me because I just said the facts. And it's disgusting that we have a mainstream financial media who doesn't have people on there who can tell them the facts about wages, about people who don't make wages any longer, who've lost their jobs, who are retired, the real level of the CPI, how many months has been above a 2%. It's terrible. But that's why I come on places like Silver Bullion and Patrick Vieira.
Yeah, no, that's why we need you here to give it to us straight and to open up our eyes to really see what's going on. But in this, where it seems like mainstream media is starting to dislocate from Main Street. Federal Reserve, they seem to be a player for the banks, a player for Wall Street. Do you think they recognize this, call it collateral damage that is happening to to middle class, to the middle class, and how does the middle class come back?
Well, the middle class comes back after a lot of pain because we have such a massive distortion in markets. Markets have been obliterated. They've been usurped by the Federal Reserve and the Treasury. So we have an artificial edifice. It has to be knocked down. We need to have home prices fall about 40%. We need to have stock prices fall by about 50%. And we need debt levels to be pared back. I mean, we didn't even talk about the private credit market. I mean, these are markets where there was not, they were hardly even in existence years ago, and now they're like trillions of dollars in private credit. These are loans to businesses that are highly leveraged that can't tap the corporate bond market. CLOs are through the roof. Corporate debt is through the roof. Junk bond issuance is through the roof. Mortgage-backed security. We still have a problem with commercial mortgages. We haven't settled that yet. And all of the things that are supposed to help out this this market, which is the Fed rides to the rescue and cuts rates, and rates fall on the long and short end. They fall much more quickly on the short end than they do on the long end. That makes everything, eventually, it remediates the problem, makes everything go away. All these debt problems get resolved because asset bubbles love lower borrowing costs. But it's the opposite. The exact opposite thing is happening today. So we have a lot of issues. We have chaos coming, and as I said before, and I'll say it again, buy and hold 60-40 is, you got killed in 2022 doing that. You're going to get even murdered worse probably in 2025.
Currently, Michael, do you see us in a, let's just say, a disinflationary environment, or what environment would you say we are in, and what environment would you say we're headed to, whether it's recessionary or back to inflationary? What do you think?
So right now, I said that I am not short right now. There's five sectors the economy is in, and I look at the second derivative of inflation. So I look at deflation, falling prices, disinflation, where the second derivative is falling, stasis, reflation, and then have hyperinflation or stagflation. Those are the five sectors. Now we are in sectors 3 and 4 right now, where the economy is kind of in stasis or sort of reflation right now. I don't know if it was China's big, I have to say probably China's stimulus program, draining of the reverse repo facility has kept us in this out of sector one for sure, which is, I said, deflation. Maybe it's the Trump election euphoria. Maybe it was the fact that the Fed cut rates by 50 basis points. So we are in the sojourn in sectors 3 and 4, which is a pretty good place to invest. My thesis is that sometime in 2025 we're going to enter sector 1. So we're going to go back to sector 2 and then quickly to sector 1, which is when you see the repo market, money markets freeze. You can't float commercial paper. You've got a huge problem in the money markets, and that once that gets clogged, you can quickly go to deflation, and a chaos. The chaos will rule. And then I want to just button that up and say, and then after that, I think the Fed is forced to, because the Fed is not charged with protecting the middle class. They pretend that and it's a nice guise, it's a nice ruse, it's a straw man. They are in existence to protect banks. That is what they are. That is what they were formed to do, and that is what they care most about. And they'll say, well, the banks can't, the middle class can't function without well-functioning banks. That's their cover. Okay, whatever. But they're there. They will cut the interest rates back to 0%. They'll end QT, go back into QE. There'll probably be some round of helicopter money. And then I think we're going to see inflation just skyrocket. We'll go to sector 5. That's my theory.
Inflation, is that one of the drivers for the chaos that you're talking about? I mean, how do you see chaos playing out?
I see chaos playing out in a collapse of housing prices and a collapse of the stock market, engendered by a freezing of the money markets, which is deflationary. Those things are extremely deflationary. You can't if you can't float commercial paper, you can't make any short-term loans anymore. You can't borrow money short-term in the repo market. That is the most deflationary thing that you can ever have, because the economy doesn't function without the money market functioning.
This inflation, I think we recently saw Putin. They raised Russia's key interest rate to 21%. When this inflation comes about, will we have the backbone to raise rates to a number such as that?
No, no, no. We will never. I've given up all. Not that I had a lot to begin with, but I gave up any hope in the central bank to ever do the right thing. I mean, Powell tried. He feigned an interest in doing the right thing. Got rates to 5.25% to 5.5%. Looked good, but now he's panicking. And let me tell you the real reason why he's panicking. It isn't because the stock market's doing terrible. No, that's not true. It isn't because the money markets are frozen. They're functioning very well. Credit spreads are as tight as they could possibly be. It isn't because inflation is plummeting. That's not true. It isn't because the unemployment rate is spiking. It's not true. It's way below average. Powell panicked for one reason, because he doesn't want his friend Janet Yellen to pay $1 trillion+ a year on interest payments on the debt. That's it. I mean, he can't be honest and say that, but that's the real reason. He doesn't want Janet Yellen to have to pay 20% of all of our revenue on interest payments. Funny thing happened though, Jerome, when you cut interest rates and the bond vigilantes say, oh, Mr. Powell, you no longer care about inflation, or controlling inflation. Well, then we have to care a lot about it. And interest payments are going up across the yield curve, from two year all the way out to zeros, 30 years and longer. Interest rates are spiking. So our debt service payments will be going.
We're seeing a lot of gold buying, gold prices going up, gold in Walmart, Costco being, basically taken off the shelves as soon as they come in. Might it be a good time? I mean, people are really looking for these safe haven assets right now.
Yep. Yeah, I own over 10% of the portfolio in gold. I actually picked up silver about a month or two ago. I looked like it was primed for a massive long-term breakout, which is exactly what happened. So if you don't have precious metals, which aren't part of your 60-40 portfolio, right, you're going to be left behind. Because here's why I say that. Real interest rates are going to be negative for a very, very, very long time. They're not negative now, but they're going to be negative for a very, very, very long time. Years, if not decades. That's my thesis. Until we have a clash with hyperinflation, which is, I mean, I'm not trying to scare people, I'm not using hyperbole, but who would have ever told you when I first got in this business in early 1990s that one day our central bank would print trillions and trillions of dollars in the matter of a couple of years? They think you're completely moronic, because back then the Fed's balance sheet was like $100 billion. The entire balance sheet was nothing. So I would sound like a buffoon, like a Cassandra. But that's exactly what they have done. And they were doing it before COVID. Okay, so the Fed's balance sheet was $4.5 trillion. So it was a result of the global financial crisis. So his balance sheet could go to $20, $30 trillion. The national, you could have a national debt that has $60 trillion in the next 10 years. We have multiple $1 trillion deficits every year for the next 10 years. At a minimum, you're going to have $2 trillion, $3 trillion deficits. That's without, God knows what Janet Yellen, I'm sorry, if Kamala Harris becomes president, if she has all these spending plans to give people, everybody gets a house, everybody gets, some money for a child, God knows what they could go. And that's saying The deficit is going to rise 20 to $25 trillion in the next decade if there's no recession and if there is no inflation. You want to bet me right now that there'll be one of those two things in the next 10 years? So that's what the gold market and that's what the gold and silver market is sniffing out. It's bond market chaos more than anything, and real interest rates being taken.
Michael Pinto, you've given us a fair bit of hope and a fair bit of warning. With that, before we wrap up, can you tell the people out there how they can follow you and support your work?
So the website is pentoport.com, and on it I have a podcast called the Midweek Reality Check. It's $50 a year. There's a 5-week free trial. Sign up for it. See if you like it. If you don't, you don't owe us anything. And if you have $100,000 to invest and you are a U.S. citizen, I'll invest your money for you in my proprietary inflation, deflation, and economic cycle model and portfolio. Pentoport.com is the website.
All right. Yeah, I hope people take you up on that. I mean, times are really it's always been uncertain, but it's getting quite a bit more uncertain, and I think we all need ways to protect ourselves right now. So with that, I want to thank you for your support, and I hope we can do this again soon.
Thank you, and continued great success, Patrick.
That was Michael Pinto sharing his views on the economy. To see more of Michael's views and work, please do visit pentoports.com. If you like this video, please do subscribe and give us a thumbs up. Both are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.